if rates go up, prices go down. That's, that's just fact of life. A bond with a 3% interest rate is very desirable when interest rates are 0, but not desirable when interest rates are 6. And it has to decline in price in order to provide an adequate return when rates go up. So this is the relationship. Rates up, price down, rates down, price up. And that's immutable. However, all assets decline in value when prices go up. The value of an asset is the discounted present value of the future cash flows. And the discounted value goes down when the discount rate goes up. That's immutable also. So I think that it's something we have to worry about. I think I know the Fed is not worried about inflation. And if you look at the world, Japan and Europe, for example, have been trying to get 2% inflation for the last decade, and they can't do it. So, and even in the US, there's something called the Phillips curve, which has been thought to define inflation, that inflation goes up when the unemployment rate goes down because the slack goes out of the economy and workers get more negotiating power and so forth. And so we've had low unemployment, and I should say declining unemployment for the last 12 years since the global financial crisis. We've had the lowest unemployment rates in 50 years in 2018 and 19 and into 20, and we still haven't had inflation. So I don't think we can be doctrinaire about the fact that we'll have inflation, and so I think we have to have our investments. Again, there's nothing we can do about the possibility of inflation. We certainly can't be sure it's coming. We can't eliminate our portfolio holdings, but I think we should invest in a cautious manner. What does that mean with regard to inflation? It really means no long bonds. That's the most important single thing, because if you have a long bond and inflation and rates go up, it has a very difficult effect on a long bond. Short bonds are not that affected. So I think, again, invested but cautiously is the right thing. Well, look, I think that India has great potential. It has enormous resources, especially human resources. It has good respect for education. The people that I meet in India are impressive and disciplined and intelligent. And I think that India has a bright future. It has to kind of get itself together and operate well. But we have a group in Singapore which we're devoting significant resources. We're active in India, and I'm optimistic about it. I came back from my trip a few years ago, very impressed, and I look forward to my future with India. Well, I think that China also has a great future. I think that they too have great resources. They are very organized. They have a benign autocratic government which makes decisions and implements them effectively and promptly. It is true that their growth rate is decelerating, but it is still very high relative to the rest of the world. They can produce 6+% GDP growth, and that is very much above average for the world. U.S. is at present less than half that, so now they have some difficult transitions. It's hard to transition from 12% growth to 6%. It's hard to transition from an economy that has been accelerated by very strong availability of financing for fixed investment, which maybe has produced excessive fixed investment, and they have to make financing less available and have less fixed investment take place and transition to a consumption economy. They have to transition from an export-oriented economy to a domestic consumption-oriented economy. So there are a lot of transitions that they have to make, but so far they seem to be making them well. And they did quite well in 2020 compared to much of the rest of the world, and seem to be coming out ahead of much of the world in 2021. Again, we're optimistic on China. Now, I always say that the U.S., for example, is a mature adult, and India and China are adolescents. And I've had adolescents at home, and the world with the adolescent is rather tempestuous and up and down and volatile. But the outlook is very positive for the adolescent. And I think that's true of India, and I think it's true of China. And we're very happy with our activities there, which are substantial. Yes. Well, I'm not convinced that inflation is not coming back. And I'm not convinced that rates aren't going higher. And the people who are sure that you can inject massive amounts of liquidity into an economy and sure that you can run enormous deficits and increase your debts and not have any inflation, I think their confidence is misplaced. I'm not a forecaster. My saying is always, we never know where we're going. We should know where we are. That should inform our actions. I'm not an economist. I don't say I know what's going to happen with inflation. I just think that it's hard to believe that we can have the benefits of injecting trillions of dollars into the economy without and running up our debts in the trillions. And last year we added about 25% to our debts and 6 trillion to our debts. And I think it's overly optimistic to be confident that we can do those things without any negative consequences. That's all I would say. I think that the cycle, I think that behavior has been aggressive. And I think that it's been aggressive for 2 reasons. Number one, because aggressive behavior has been rewarded in the last 10 months. And number 2, because interest rates are so low, we're in a low return world. And if you say we're in a low return world, but I'm not content with a low return, then you have to be active in an aggressive way in order to get high returns in a low return world. It's risky. And you shouldn't do it with the Pollyanna attitude, with great confidence. It's not my style. But you have to. Most people feel they have to do it because they can't settle with returns of 0 on cash, 1 on treasuries, 2 on high grade bonds. Most American investors need 7 or 6 or 7.5. And in order to do that in a low return world, you have to behave in a risky fashion. On the other hand, I'm not worried about the economy because I think we are at the beginning of a positive cycle. And I would not encourage, again, people to not invest. But I think that in a world where many people are behaving in an aggressive fashion in order to make a high return in a low return world, I would not behave in an aggressive fashion. Buffett says, the less prudence with which others are conducting their affairs, the greater prudence with which we must conduct our own affairs. And I think that's a good motto for today.